Amazon, otherwise known as Amazing Zon. That was stock number 3 of 4. Now up $175,000 on the stock in the public account. I own the stock in the Patreon portfolio heavy. I own this stock in my private portfolios. Like Amazon, this is just a stock you have to own. You have 3 core businesses of this company. You have the e-commerce business, you have the AWS business, right? And you have the ads business. Now you have a bunch of other random businesses off of those, but those are the 3 core businesses of this company, right? No, Amazon is actually a hated stock, believe it or not. And it's just started a new move here recently, so it's starting to get people a little excited. Like this is like move in the past like week basically that's starting to get the stock moving. But this stock has been destroyed by the S&P 500 and the NASDAQ over the past 5 years. They may say, why? How? Amazon's grown their business so much the last 5 years. How could they have gotten outperformed by the S&P 500? And not just like a little, wrecked. This company's been wrecked by the S&P 500 and the Qs. 53% gain the past 5 years. The S&P 500 is up 95%. The Qs are up 114%, right? People are like, this stock is just the worst, right? Here's how that happens. 1, 5 years ago was Rona, right? Everybody is forced to be home. You got the lockdowns or whatever you want to call it, all that stuff at that particular time. Growth rates were exploding for Amazon. People thought that was going to last forever. Those sorts of insane growth rates, obviously, they're going to even out over time, right? So you have that come down. Additionally, people were willing to pay any price for Amazon stock at that particular time because the e-commerce growth was so strong, the AWS growth was so strong. They were willing to pay anything for Amazon, right? When you're willing to pay anything for a stock, there's going to be a lot of pain to come in the future. And that's exactly what we've seen and we witnessed in Amazon over the last 5 years. Massive underperformance. But what you're going to witness over the next 5 years is not only outperformance of Amazon versus the Qs and versus S&P 500, but it's going to be massive outperformance. It's not even going to be in the same stratosphere. You're going to look at Amazon's returns over the next 5 years, and you're going to look at the S&P 500 and the Qs over the next 5 years, and they're not even going to be in the same ballpark. You're going to be in complete shock by how much Amazon essentially outperformed the indexes in general, and honestly, a lot of the Mag 7 stocks as well, right? No, what Wall Street cares about more than anything else, and this was posted on the 1000X X page actually, is AWS growth, Amazon Web Services. And what we just witnessed is a major acceleration of AWS growth, and that's what everybody's been waiting for. And that's why the stock has all of a sudden started to move up in the last week, because they reported this AWS growth was much better than expected. And all of a sudden, Wall Street's like, Amazon's back, right? Now, additionally, just today, Amazon and OpenAI announced a multi-year strategic partnership. It was a $38 billion deal for AWS, which is quite substantial, right? Now, additionally, in regards to Amazon, is they are laying off 14,000 corporate employees, right? And in regards to this, Andy Jassy says it's a culture. It reminds me a lot of Meta's move in 2023. So kind of at the end of 2022, in the beginning of 2023, Zuckerberg did a mass layoff at Meta, right? Mass layoff, leaned out the organization in a substantial way. And Meta had been overhiring for years, kind of like Amazon likely overhired as well. And Zuckerberg realized, like, we got a lot of players that are not A players at this company. I guarantee the same thing happened at Amazon. They probably hired so many employees that were just okay. And if you want to be a high-performing organization, you can't hire okay people. You need to hire the best of the best. And there's just no way, a company like Amazon, everybody there is the best of the best. There's just no way they're all A players. Not going to happen. They probably had a lot of D and C players. They probably did, right? Maybe even some B minus players. And they said, we got to get rid of those individuals, right? That's what ends up happening. And so that's business, right? It's not personal, it's business. And they had to make that move. And what that's going to end up producing is likely Amazon's culture is going to end up being a lot better over the coming years, right? Because A players don't want to be around C players. I can tell you that much. That's brutal. It brings the whole team down essentially, right? And additionally, this is obviously a huge cost-cutting measure. It hurts profitability in the short term because you got a bunch of one-time costs that kind of take effect over a quarter or two. But over time, obviously, it's going to bring down Amazon's expense profile substantially, and their profitability is going to explode way faster than revenue. So if you're thinking about this company growing revenues at 15%, let's say, don't be surprised if net income's going up at a 30 or 40% clip in that sort of situation, right? Now, in regards to Amazon's latest quarter, $180 billion from $158 billion. Income before income taxes, $28 billion versus $18 billion. Net income, almost over $21 billion from $15 billion in net income. Diluted EPS, $1.95 from $1.43 for Amazon. Huge improvements there, right? No, the only thing I kind of poked at and why I gave them a B minus grade is some of their expenses were definitely high. Cost of sales was a bit high. Technology and infrastructure was a bit high. And then they had this total operating expense that hit them. That was about $2.8 billion there. So that's why I graded them. Now, what's my bull case, base case, and bear case for Amazon? Well, here's the thing you got to understand. Listen, I might take these numbers up. In regards to my bull case, my base case, my biggest thing is I need to see that AWS growth next quarter. If that AWS growth accelerates again to, let's say, 22, 23, 24%, all my numbers you're witnessing here have to go up on my bull case and my base case, okay? So just understand what you're seeing in front of you right now. I might have to make adjustments 3 months from now, okay? I'm doing 14% revenue growth as of right now for 2026 to 2029 and 20% net income growth, okay? If you got that company like Amazon growing at those sorts of rates, 35 to 40 P is fair, rated about a double an average stock in the market. They're doing over double revenue growth, over double net income growth. So you should be able to command at least a double PE, right? 20 to 24% CAGR in the stock over the coming years, right? Remember, if AWS growth goes 22, 24%, 25% or something like that, this bull case you're witnessing here, this is going to become my base case essentially, okay? My base case, honestly, probably need to take that up to where the bull case is right now, right? Because as of right now, my base case has only 12% revenue growth, which is, much slower growth than obviously what they have right now. Net income growth at 18%, 33 to 38 P would be fair for a company like Amazon growing at this sort of rate, which gives you a compounding annual growth rate of 16% to 20% for this company. This probably needs to come up, right? My bear case, I won't move this one. I'll keep this one here. 10% revenue growth on average per year for the next 4 years, 15% net income growth on average for the next 4 years, 30 to 35 PE, and I still get a double-digit CAGR between now and 2029. I got to buy it. Like, you got to own it, man. Amazon's a must-own in every single portfolio out there. It is a must-own. For the pinned comment down there today, I'm going to put the application if you're looking to apply to join my private stock group, private wealth group, all that good stuff. Remember, January 1st, we're moving to $100,000 minimum net worth to join in there. So if you're under 100K net worth, you might want to get in there before January 1st. And also, we have our new lifetime membership card for anybody that joins on a lifetime membership. Usually just get your Steel membership card for 1000X and your private group Steel membership card. But now if you're a lifetime member, you get the black card as well. So do keep that in mind. And then we're now up to 2,849 members of the private group. So I'm thinking about potentially closing the private group to new members when we hit 3,000 and then opening it back up at some point in time in, let's call it 2026. The demand's been overwhelming in there. Just yesterday, we received another 100 applications after receiving 500 applications last week. It's been ridiculous. So that's going on there. Pinned comment down there if you're looking to join us in there, okay? Celsius Holdings. Listen, ladies and gentlemen, this stock does not deserve to be down the way it was today, okay? There's some other stocks that were down huge today, and I'm like, I get it. Celsius, no. Not only should this stock not have been down, I could make a strong argument that it should have been up today. And I can't say the same about a lot of the stocks that were down today. This one I can, okay? They reported a B grade income statement. Now, this would have been an A plus grade if it were not for one thing. Okay, so look at this. Revenue came in at $725 million. That's versus $265 million in the same quarter last year. Gross profit went to $372 million in this quarter from $122 million in the same quarter last year. But look at this right here. They had this one-off expense line item, distribution termination. It was a $246 million one-off here. Okay, so that made their profitability look horrible, right? It made them look like they lost money in those sorts of things. But we have a private stock group member that did a little digging in regards to this. This is one of the other beautiful things about having the private group. We're all digging into these stocks all the time, running projections, keeping up with the news. Look at what one of our members found here in regards to this distribution agreement, okay? PepsiCo has agreed to fund the termination fees associated with moving a significant portion of Alani Nu into the PepsiCo distribution system, resulting in net neutral cash position for the company. While the company's cash position will not be affected by the termination process, generally accepted accounting principles require the company to record the estimated termination expenses on the income statement. While the payments received from PepsiCo to fund such terminations are required to be recorded on the balance sheet and amortized over the life of the distribution agreement, resulting in a timing difference on the income statement. Ladies and gentlemen, that one-off is like the most fake one-off ever. Like, this is the best situation you could have imagined here, okay? So this is what just happened with Celsius. You just got a massive discount because people are lazy and the algos are lazy and they have no clue what's going on here. And so they think the company just took $250 million one-off fee when PepsiCo's funding it, right? Like, are you kidding me? Like, you got to be flipping my flapjacks. This is insanity. What happened in Celsius stock is insanity. And that's why I say there's a lot of other stocks that fell big today. And like, I could make a strong argument why they fell, right? Some of them definitely fell way too much. I'll be honest about that. But like, I could understand them not going up on their earnings. This was the one that I'm like, this stock should have been up today. This stock should have been, they just made a massive mistake in regards to this one. But you know, some people do the research and do the digging and find out things and others don't, right? And that's the stock market for you. Now, what are my projections for Celsius? Okay, so here are my projections for Celsius and where the stock is going over the next few years. Basically for every case I have for Celsius is revenues are going to go up about 30% range next year in 2026. And then 100% net income growth there because they're not going to have that one-off next year, okay? Now, I think, honestly, I'm going conservative on both those numbers because you got to remember the Rockstar will be full year impact positive 26, and then Alani is going to be part year, right, where they weren't in 26. So that's going to help revenue growth as well, and then we know the Celsius brand is growing, and we know international. So I think 30%, I'm actually being conservative for all three of these cases regarding revenue. And I think I'm also being conservative with 100% net income growth because remember, there's a $246 million hit they had to take here in 25 that then's going to not be a hit in 26. Remember that. And then, like, profitability should go up quite substantially next year because you know why? They're not going to have any of these one-off like expenses in regards to the acquisitions like they had this year with Alani, with Rockstar. So honestly, could this company have net income next year of $600, $700, and maybe $800 million? The answer is yes. But I wanted to, like, would I be shocked if Celsius had net income of $700 million next year? Not at all. 0% I would be surprised. But I wanted to go more conservative. I want to have them a little less than $500 million in net income in 2026 for this company, okay? So that's how I ran all my scenarios. Now, additionally, from my bull case, I ran them only revenue growth of 15% per year, 27 through 29. That also might end up being a conservative number. When you think about Celsius's growing brand, when you think about internationals, like they're just starting to really get to that international opportunity, right? When you think about the Alani, obviously scaling of that business, I mean, 15% might end up being conservative. And then remember, price increases over the years and things like that, right? And then have them doing 25% net income growth. They should get a lot of leverage on that, bottom line over the coming years as they scale it out. They don't really need to hire a ton more employees. They've done a lot of the hiring in the past couple of years, and now they got the Rockstar team, the Alani team, all that. If anything, they might actually lighten up on employees, in my opinion, over the next year or two. So net income should go up way more substantially than revenue should actually go up for the company, okay? So I've been getting $900 million in net income in 2029 under my bull case scenario. 35 to 40p would be fair for a company growing top line 15%, bottom line 25% in the drink industry. And so that would give me a compounded annual growth rate well into the 30s, ladies and gentlemen. Well into the 30s. Now keep in mind, 26 is such a key year because if they were to grow that net income to $600 to $700, $800 million next year, keep in mind that completely fundamentally changed all these estimates. Then we could be talking about, like, let me show you how much this changes it, okay? So let's say they grow net income next year by, I don't want to go, that's probably a little too much, okay? Let's say they grow it by 150% next year. So they push to 579 million. Look what that just did to my numbers here, okay? Now we're talking about CAGRs into the 40s regarding this company. So this is why 2026 is going to matter so much for what their net income is. Okay, keep that in mind for next year. Pay attention to net income because it's going to completely change these numbers here. I think I went very conservative with being net income of 463 million next year. That's a net income margin of only 14% roughly. Keep that in mind, ladies and gentlemen. Okay, base case for this company. This is basically just a fancy way of saying what I expect, right? Kept all the numbers for 26 the same across all the cases. Then I have them only doing 10% revenue growth on average, 27 to 29. Is that not a conservative number? I think that's pretty darn conservative. 15% net income growth. If you got a company in the drink industry growing top line 10%, bottom line 15%, 28 to 33 P is very fair for that company. And we're talking about a CAGR midpoint right around 20%, right? And once again, watch how this changes if we're talking about that profitability in 26 is a lot better, right? Look at how this changes my case. Now we're talking about the compound annual growth rate is actually going to be more toward the 25 to maybe even close to 30% range. Whew. Yeah, this is why like Celsius should not have sold off today. It was ridiculous, okay? And revenue, as far as the bear case for the stock, I'm only doing 5% revenue growth, 5% net income growth. Yeah, and if that scenario plays out, like it's going to be hard to make money in Celsius over the next few years, but not a very realistic scenario there, right? So Celsius this is a huge gift. There's no other way I can put it. Like, if people are buying Celsius stock in these prices, like they just got a massive gift here today. And all you can say is thank you very much for that. Because it looks clear to me that Celsius is on its way to becoming the next drink giant. And when we start talking about drink giants, we're talking about $50 billion, $100 billion plus market caps, right? They're $15 billion. So there's a long way to go in this party. All right. Next one up here, Elf Beauty. Oh boy, let me take a drink before we talk this one. Okay. This one got hammered today. Now, should Elf have been down? Yes. Elf should have been down today. Should Elf have been down 35 percentage points today? Absolutely not. I believe the company deserved to get dinged today, right? Because they missed their revenue estimates, and that like people pay attention to revenue estimates more than anything in regards to Elf. So the stock should have been down. The stock should have been down 5 to 15%. Not 35%. This was way like just the market being ridiculous. Okay. Here are my Elf estimates for this company over the next, 4 years roughly. Okay. Here's my bull case for Elf. 25% revenue growth in 26, right? Because they're going to have the full road deal, that's going to be fully integrated in 26 for the company, right? So their revenue should be very strong. The company's guided for 18 to 20%. I think they're guiding low because they missed revenue estimates 2 straight quarters. So I think they want to do numbers that they know they can easily beat. That's my personal opinion. Okay. So 25% revenue growth in 26, and then doing 20% revenue growth per year, 27 through 29, 35% net income growth in 26, and then 30% net income growth, 27 through 29. They should be able to run that business very lean. My guess is in 26, they'll probably get a lot of the cost out of the business. They're probably going to have a lot of duplicated roles because of acquisitions they've done over the next few years. So I wouldn't be surprised if they do a layoff and maybe clear out some employees or something like that, or they just keep the current team and just basically have like a hiring freeze for the next few years. In my opinion, I don't think they need to do hiring in any substantial way for the next several years essentially. Okay, so net income growth there, 35 to 40 PE would be very fair for this company if they're growing revenues 20% a year and net income 30% a year, right? And we're talking about a compounding annual growth rate of 40-ish%. 40-ish% under that scenario. We're talking about a stock that goes to the high 200s to low 300s. Today, the stock, you can buy it for $76. Pretty attractive. Here's my base case. This is just a fancy way of saying what I expect for the company. I expect them to grow revenue 23% in 2026. I expect their net income to actually not go up that much next year under my base case, essentially. I'm expecting only 15% growth for net income. All right. Then I have their their revenue going to 15% growth per year, 27 through 29, and 20% net income growth per year, 27 through 29. If you got 15% top line for a cosmetics company, 20% bottom line, 30 to 35 P is very fair for a company like that, right? Because people just keep rebuying these products again and again and again. That gives me a compounded annual growth rate in the 20s. Elf's a buy today. Elf is a flat out buy today. Will Elf stock go up in the next 3 weeks? Who knows? Who cares? The bottom line is Elf stock is going to be on its way closer to $200 over the next few years than it is, $50 over the next few years. So are those numbers like crazy? Like, no, those are, if you're educated on Elf stock, you'd be like, that's pretty like conservative numbers, if anything, right? My bear case for Elf has them only growing revenue 18%, the low end of their range in 26, with no net income growth next year. Then only 9% revenue growth per year after that. And only 9% net income growth per year after that. 23 to 28 P, and I still make money. Like, those are dog dirt numbers there. Those are dog dirt numbers. Oh gosh. Put them in the pig pen with the mud. That's what type of numbers those are. And I still make money. Not much money, but I would still make money. If I can still make money in a bear case, it looks pretty attractive. So Elf, huge gift. Huge gift. You know, where's the next $20 for Elf? I have no clue. I don't know if the next $20 is down or up. I don't know if the stock's going to be $56 or $96 next. But I think I know where the next $100 to $200 is, and it's to the upside, okay? Bottom line in regards to that. Honest Company, alrighty. Honest Company, next up here. 30% hit today. This one, did it deserve to be down? Yes. Did it deserve to be down 30%? No, absolutely not. This is silly. Stock should have been down 5 to 10%. This is silly. Okay, $259 million market cap. Keep in mind the company has cash and cash equivalents right now of like over $70 million with no debt. And they keep bringing in money. So like this was ridiculous. Okay. Now people are freaking out about the diaper business, right? The diaper business fluctuates crazy because a lot of it depends on when Target or some of the other retailers place their orders. Okay. Sometimes Target and other retailers will place a massive order and, you know, Honest diaper revenues go flying. And sometimes they don't place a big order during a quarter. And guess what? A big order during a quarter, we're rhyming. And guess what happens? Their revenues aren't quite there for the diaper category, right? So that's something to keep in mind in regards to this. And obviously people are really worried about revenue. Revenue growth, there's not going to be revenue growth for the next year, right? Unless a miracle happens. There's going to be no revenue growth because they're going to exit several product categories that are hurting their margins, that's hurting their profitability, right? And so they're getting out of those. So I understand if somebody's looking for revenue growth, they're looking at Honest and like, there's going to be no revenue growth for next year, I'm out. Peace. I get it. I get it. When there's revenue growth again, do you think Honest is going to be $2 a share? Nope, it's not. That's the thing. It would be so perfect if it was like, I'll wait till their revenue starts growing again in 27, I'll get back in this stock, right? Think it's going to be 2? It's not going to be $2 then. It's going to be $4 or $5, $6 then. Because more than likely what Carly and the team's going to show is even as their revenues are going down, likely their margins are, guess what? Going to go up. So as their margins go up and their profitability goes up despite revenue going down, once they get out of those businesses and exit the product categories that are hurting their margins and profitability, then people are going to start extrapolating numbers and going to be like, oh gosh, they're going to start turning revenue positive again in 27, right? And you've already got margins and profitability increasing with revenue going down. What do you think is going to happen when the revenue starts going up again? Oh my gosh. It's just math, ladies and gentlemen. And so, you know, keep that in mind. The stock's $2 today. When revenue growth is there again for Honest, it won't be $2. It will not be $2, okay? And so, silly move in regards to Honest. And I understand it's a hated stock. No one wants a piece of that stock. We'll see in regards to that. I'll likely be buying Honest in the public account, more shares here soon.